Okay, it's 4:05, so being mindful of time, let us begin. So a very good afternoon to everyone from Singapore. Thank you for joining us today for the Silverdale Globally Review Call, June 2022. My name is Dandy, and I'm part of Silverdale Investor Relations team, and I will be moderating the quarterly review call today. The June 2022 quarter was one of the worst quarters in almost 150 years of capital market history. The straw that broke the camel's back was, of course, the higher than expected CPI prints of 8.6%, which eventually nudged the Fed to do one of the most aggressive rate hikes of 75 basis points. This resulted in rates selling off, which in turn also sparked fear of recession, resulting in spreads widening. On this challenging backdrop, Silverdale Bond Fund portfolio delivered a negative 2.04% for the June 2022 quarter, as against indices which were down between 2 to 9%. Post leverage and expenses, the fund gave negative 5.66%, and during the quarter, the fund also paid its quarterly dividend of $2.10, taking the trailing 12-month dividend paid by the fund to $8.40 per share as per our endeavors. May I now request our CIO, Mr. Sanjay Guglani, to take us through the performance of Silverdale Bond Fund and, of course, share Silverdale House view on what we can expect in the coming quarters. Over to you, please, Sanjay.
Thank you, Andy, and a warm welcome to all of you. It's always a pleasure to address you directly. And of course, look forward to your continued support and, of course, to address any queries you have. As usual, before I begin, I'd like to give you the overview in terms of what's happening, what has happened, and what we want to do in the coming quarter. Hope you can see my presentation, please. Oh, thank you. So as my colleague Dandy mentioned to you, it was one of the worst half years in the last almost 150 years. For the government bonds was the worst time since 1865. And even for the equity market, it was worst time since 1872. Not surprisingly, then most of the bonds across the board had a very steep fall, irrespective of which tenors you're looking across out there, across the board, across the spectrum sector out there. And we know the reason, right? It's primarily because of the inflation, which has been fueled primarily with the high energy cost, which has been triggered, of course, among other things, in terms of the Russia-Ukraine conflict. Having said that, from the market implied inflation rates, we do expect the inflation rate to finally come down, as you see from the graphics there. And that's also been reiterated by the Fed in terms of the future inflation trajectory. Now, this long-term interest rate is very, very important because if you look in terms of long-term market neutral rates, the Fed terminal rates, they still continue to be about 2.5%, something which we have been iterating since beginning of the year. Many of you I had privilege to meet you in the Q1 and the start of Q2, and I mentioned that the rates expectation will be 2.5, with the Fed doing overshoot by about 2 extra hikes, maybe taking to around 3%. And what happened on 10th of June is very important because on 10th of June, the CPI print, which is expected to be around 8.1, actually came at around 8.6. This spooked the market big time, and the Fed was forced to deliver a 75 bips rate hike as against the expectation of 50 bips. This is the spike which is on a graph which you see there. But as I mentioned in my presentation in the Q1 also, if the rate hike goes much beyond it, the onset of recession will be preponed. Just to remind you, at that point in time, the market was expecting recession to come in late 2024, around that period. And while now the market expectation of recession has moved to 2023, and of course we have investment houses like Nomura, we talk about the recession coming as early as Q4 of 2022. I'll develop on this point in my further slides. Now, when the recession comes, first and foremost, there will not be much rate hikes, and more importantly, there will be some rate cuts. Therefore, what you see subsequently is in terms of, again, the market expectation in terms of year-end rate coming down. It also means is, of course, in terms of the bond spreads, which I again touch upon in the coming few slides. So in a nutshell, what has happened, what's likely to happen is this. So we have seen a rate hike to 1.5%, consists of about 6 rate hike of 25 bips each. And at the end of the year, the market expecting the Fed rate to be around 3.35%, or about 13 hikes. The delta between the two being the probability versus the actual rates. And thereafter, after a period of being stagnant for some period of time, the market expects actually the interest rate to cut in the second half of 2023 onwards. This is also seen from the treasury curves, and you will see the difference is hardly anything across up there. So what has happened is this, that while the rate hike expectations has been preponed, but in terms of the actual rate hikes, it's becoming more and more flatter. So the key point is that the number of rate hikes in totality number has not increased in the broad sense of the word, and that's very, very important to keep in mind. From the Silverdale fund point of view, as you know, we are basically short duration fund. From that point of view, if you look in terms of 2-year treasury, it has already moved from 11 bips to about 300 bips, which at the back of my calculation wise is actually higher than it should be, which basically means as the market comes to normalcy, you will see certain amount of rate cut being priced in. As far as the bond spreads are concerned, so we know in terms of the risk-free rate to government rates, I think all of us agree that the market has priced in all the potential rate hikes, and any further rate hikes would prepone recession across up there. So let's keep some takeaways to you. First takeaway is that in terms of rate hikes, what has to be done has been done. In terms of the rate hike expectations set out there, anything more they do will prepone the recession. Now I want to be, point number 2, be very, very specific about it. It's practically impossible to have a rate hike and not have the GDP slowing down. I repeat again, it's practically impossible to have a rate hike and not have a GDP slowing down. Whether the inflation comes under control or doesn't control is secondary thing. So people could have an opinion about stagflation, but nobody can deny the fact that if you do a rate hike, the GDP would slow down. Just keep this in mind. Now, as we look on the end of the quarter, in terms of the bond spreads have been very close to what was the December 2018 peak. The orange line is the level as on end of June, and the yellow line was the previous peak. As expected, when the recession fears increase, the spreads would increase, and we did see a bit of increase in those spreads. In terms of the Fed tightening, I shared this slide earlier to you. I just want to remind you once again to you shrinking the balance sheet by 3 trillion is equivalent to approximately 3/4% to a percentage increase in the interest rate. So from that point of view, the way to look across is that the shrinking of the balance sheet itself also spooks the market in a big fashion. What this implies from the consumer behavior is very important. So what's happening is this: because of the fear of inflation, to be technically more correct, because of fear of inflation and the adjunct recession, the consumer sentiments have been very badly hit. And as you know, US is predominantly a consumption economy. And what we have seen always, that when the consumer sentiments comes down, the corporate margins effectively also follow it. So from the consumer confidence point of view, we are at very close to bottom level, one of the worst levels in terms of consumer sentiments. And the consumer confidence level also is ticking down. Among other reasons is because of wages. A lot of people have been talking about the wage inflation, hike in wage, but if you look in terms of real wage growth, it has been negative. And again, when you have a real wage growth to be negative, the consumer sentiments take a hit. The other way to look across is that in terms of mortgage cost, as you know, mortgage costs in US have already crossed more than 6%. And because of spike in the mortgage cost, again, the consumer sentiments are low. Because the consumer sentiment lows, mortgage cost. Less people want to take mortgages, and which is being showing in terms of the the housing permits and stuff like that. Housing is very important because housing is one of the sectors which gives you a red flag ahead of many other indicators. And I want to spend a couple of more minutes on that. So if you look in terms of the new home sales, which is using green, we're already seeing a downtick. Nothing shuddering, but the downtick is there. Similarly, if you look in terms of this chart of new single family homes, again, we are seeing a bit of downtick across out there. Therefore, the impact of this, which will be the quarterly numbers will be revealed soon, we could see very soon coming across out there. So we have the new monthly sales and new home sales which come on monthly data, which is downtick, and therefore the quarterly residential investment as a percent of GDP is likely to also start looking at downtick. And this again shows you the same thing. Again, nothing to worry per se, but yes, we are seeing a downtick in terms of YOY new home sales. Even before the housing sales, there's one more indicator, the transportation index, which gives you a much better color. Now, in that case, the most important indicator which people widely look at it is the US heavy trucks. These are trucks which have about 14,000 pounds in terms of gross vehicle weight. So from that point of view, again, if you look at it, we are also seeing a small downtick. I would specifically ignore the 2020 numbers and take with a pinch of salt, because part of that could also be potentially be because of the supply constraints. But we do need to be cautious there. When the consumer sentiments come down, it's not unheard of that the US CEO's confidence will come down, which is close to, on again, lowest level. And this will again be following by the capex, which is start looking downtick. So what you saw in terms of the housing, sentiments are low and downtick is just starting. Here again, the CEO confidence low and the capex downtick is again showing a downtick out there. The other way to look across is that in terms of the US dollar, so when people are concerned about recession, people are concerned about GDP, obviously there will be a flight to safety and US dollar will appreciate. And that's exactly what's happening in terms of the DXY index, which has come down very come up very, very sharply. This is an inverted index, just to remind you. The white graph is the Dixie or the US dollar index. What is interesting to notice is that despite whatever we have shared with you, and we are seeing a downtick in terms of corporate profits, we would yet to see the June numbers and therefore the June projections by various corporates. Having said that, in terms of S&P 500 earnings, the market is pricing a 35% increase in the EPS. So that's a challenging time ahead for the equity markets. Having said that, it's not gloom and doom all across. We do see certain positive sparkles also, specifically in terms of easing of certain supply chain. And as I mentioned to you, in terms of transport index is set out there. So if you look in terms of global freight index, that has come down very sharply from in terms of where it has been today as it was in the beginning of the year. And likewise, in terms of consumer spending, we have huge increase in terms of inventories, specifically in terms of the consumer durable space. And we see the consumer spending coming down. So whether it's Amazon or Walmart, we see huge amount of inventory pile up. But there's again a positive sparkle in terms of the service industry. So we are seeing a bit of service industry still holding strong and being pretty close to the pre-pandemic level and even marginally up in certain places. So in nutshell, if we were to look in terms of the flash data, as per the Atlanta Fed, which is, as you know, gives the GDP now estimate, the GDP has taken a very sharp plunge. And mind you, this is a flash data, and it is not accurate for the matter in the truest sense of the word. But yes, it's only best and the earliest indicator we can see. And this deterioration has happened in last week to 2 weeks. So very sharp deterioration we are seeing there. But when you look in terms of slightly longer period of time, as given by the New York Fed, the probability of recession is still much lower. Right? So takeaway is that as investors, there are a lot of parameters each one of us can look. Our favorite 3 parameters to look at is, of course, the New York Fed, which is nothing but the 10-year minus 3 years treasury, very important indicator. Number 2 is in terms of unemployment rate. As per the New York Fed, of course, there's a sharp deterioration there, but we have to still see the numbers. We'll keep a watch there. And last but not the least is the commodity prices. People talk about commodity prices being very high, but as you notice on the graphic there, they were high. They have come down very sharply, and in many cases, even below the pre-pandemic level. Very to be very careful about it. So what does it mean for an investor? So my point is this. Look, we can all debate and go in details, and we can spend next few hours, discussing our house views on it. But the way I look across is this: either the rates will go up or may not go up. So if the rates go up, what should an investor do? Stick to short duration. If the recession comes, what should the investor do? Stick to high quality. So the key point to you is, from Silverdale Fund's point of view, anyway, our focus is in terms of being into short duration, high quality. So you are in very safe hands. Having said that, if you're still worried, you can always lock in your returns by looking into any fixed maturity fund. But what I want to strongly emphasize is that this period from July to September is one of the periods which will give you extraordinary profits. I repeat again, this period from July to September will give you extraordinary profit as long as you are reasonably diversified with a good quality asset out there. Because come September, you will have the econometric model giving you much clearer picture. And as you know, once the market knows the clearer picture, the volatility in the market will come down, and therefore the opportunity for short to medium to long-term investors would evaporate. This is a period where we have elevated yields and the cost of borrowing based on real interest rate is still low. So it's very increases, right? For takeaway point of view, that given the fear of the inflation stroke increase in interest rate, the yields are much higher, while the cost of borrowing, which is linked to actual interest rate hike, is still low, the spreads are higher. I also admit that the volatility is high, and therefore, unless you really understand it, you could be whipsawed. And therefore, my suggestion to you is that this is time to lock in across out there. And if you are still concerned, look into certain ways you can lock in the returns out there. With that backdrop, let me move on to the Silverdale bond fund. So as we already shared with you in our quarterly June commentary. So the portfolio return for the quarter was about -2% as compared to index, which was down between 1 to 6% sector out there. Post leverage cost expenses were down by about 5.5%. We continue to be well diversified, be high quality and short duration, and we have paid our running rate of $8.40 as a dividend per annum, which is about $4.20 for the current half year. In terms of quarterly, the quarterly NAV is down by about 8%. The dividend paid has been $2.10 for the June quarter. The return to investor is -5% approximately after considering the $2.10 of dividend. In terms of quality of the portfolio, almost same, marginally higher, duration marginally low, coupons almost flat, YTM marginally higher, YTM post leverage again higher. In terms of the drop, it's been principally is because of the M2M loss or price depreciation of 8%, which was to some extent countered by the high carry of about 3%, resulting in the net of -5%. For the trailing 12 months, it has again been pretty, flattish performance sector out there. The return has been down for last 12 rolling months sector out there. The dividend paid, of course, has been maintained at $8.40. Again, to remind you that it's primarily in terms of M2 loss of about 30%, carry of about 8%, resulting net loss about 21%. On a Q-on-Q basis, if you look in terms of the quality, marginally improved from 75 to 77%. And in terms of the attribution, no great change, almost same in terms of the distribution. In terms of the duration, again, marginally reduced from 1.85 to 1.79 years. Roughly about 61% of the portfolio matures, has a duration of less than 2 years as compared to roughly 58% earlier. No key change again there, very, very marginal readjustment in terms of the 2 to 3 year being replaced by 1 to 2 years because of the theta decay. In terms of distribution, no great change. Handful of our securities have matured in last 1 quarter, so you're seeing a bit dip again in last 2 weeks. We bought 3 more securities, so almost something out there. No major change across in terms of the distribution. The others 17% which you see primarily consists of 14 countries, including Saudi Arabia, Germany, Singapore, South Africa, Cambodia, Australia, Switzerland, Morocco, Brazil, Malaysia, Luxembourg sector there. In terms of the big picture, China and India continue to be the larger exposure. India was 27, now 28, almost same. China has been very stagnant around 15%, other than 17%, so no great change across out there. What I want to highlight to you is that, which I of course mentioned earlier also, our exposure to Russia, which a lot of people want to know, has been around 1%. That is, the best performing geography for us. Therefore, the exposure is about 1.6% or no great change. Our holding continues to be two, namely Lukoil and in terms of Vion holding, but we don't expect any problem whatsoever in these two names. So in terms of the returns in the last 9 odd years, we have given about 3.5% compound return as compared to index, which is given less than 2% compound return. This is after taking into consideration the recent downtick. If you look in terms of mean reversion, we see a huge upside across out there. Yes, the mean will change as we go further, but if you look in terms of the R square, we're looking about 0.75, which is pretty good in terms of where it's coming across out there. Even in terms of Sharpe ratio, much better than the index. And of course, if you compare us with other funds, we have done very, very well, whether it's BlackRock, which is given about 2.5%, or whether it's, of course, in terms of UBS, again, negative 1.5%. We've done very, very well as compared to the peer group. So across the almost 10 years period, we have been among the better performing funds in the world. In the current year, June, 2 quarters and June quarter, again, we have been in the middle of the pack. And as we always been sharing with you, that when the market is on the upside, we are able to capture a large portion of the upside. Given our leverage, we get a much higher uptick. And many of you, if not all of you, would have seen it in the 2020 COVID time, where the fund did drop because of the market being what market was, but it recovered 100% of what it drop it had in the year itself. So when you see uptick, you would see a sharper uptick happening for us. In terms of consistency of returns, we continue to be very consistent. So we have a 63% positive months. And as you see, the area under the blue is higher than the red, which shows that not only we have more consistency of return, but in terms of the fat tail, we don't have a fat long tail in terms of negative, but we do have an interesting long tail in terms of the positive. While the NAV would have M2M, what we have seen distinctly is we have been maintaining the dividend of $2.10 on each quarter. And importantly, when you see our leverage yield being elevated, the subsequent 12 months gives you a much higher return, which I always joke to people, a double-digit leverage return means double-digit return for you. So I hope we will be able to maintain those track record. You all know our risk management. I just want to highlight once again to you, this in the history of Silverdale Fund House, we never got a margin call. We are very proud of it. And we are further enhancing our risk management protocols sector out there, and which we'll share with you in the next quarter. To summarize what I've spoken to you is that the rate hikes have been mostly priced in. The impact on the Silverdale Fund has been primarily because the mark-to-market loss across out there. We confirm to you we had 0 margin calls and 0 fire sales. As a matter of fact, we are standing right now on significantly higher unutilized credit limits than normally we would have. And the reason why we're keeping the gunpowder dry is because given the volatility in the market, we would be able to pick up at much finer prices. We are continuing to be high quality fund with 75% IG, low duration, 1.8 years, diversified across 100 bonds across out there. And in terms of performance, we've been doing middle of the stream. But as we also know that once the uptick comes, we should be able to outperform the peer group across out there. The current elevated leverage yield indicates you a potential of much higher return in the coming quarters. We thank our subscribers, those who belong to more than 27 institutions, and the various platforms, which are more than a dozen, which have supported to us, and the various analytical firms, right from Bloomberg to UK, who have been kind enough to cover us out there. The data which we have is all available on these various databases, and also on our website, silverdale.com. I strongly recommend you to visit our website, which contains historic data. It contains a lot of analytical data across up there. And for the subscribers, I recommend to you also to log into the Fund Administrator portal, which will give you a lot of interesting information in terms of your holdings, in terms of the returns you had, capital gains you had, the dividend income you had set out there, and very importantly, to have a seamless subscription redemptions in the fund. These are our client-facing team and the directors, and these are some of the other funds which we're running across out there. As you know, we are very prolific in the market in terms of the funds. We have privilege of launching almost 7 funds in last about a year or so, and look forward to launching another couple of funds in the current quarter. And we thank you for your participation and look forward to your continued support across out there. We are familiar with the fixed maturity funds. I also want to highlight to you the Singapore REIT fund, which we have, which is a brilliant fund from the fact that in terms of time of inflation, one of the best performing asset class in the world historically has been the REITs, and we do have a Singapore REIT. Please reach out to us in case you want to know more about it. With that, I'll close my presentation and happy to take questions which you might have. Thank you once again.
Yeah, thank you, Sanjay. So if anyone has any questions, feel free to unmute yourself and ask your question, or you can leave your questions in the chat box if you're more comfortable with that, and we'll address them. Thank you.
So we already have a question which I see. So the question is that how does increasing interest rate and therefore increasing cost of your leverage affect the fund and its performance? So as I mentioned to you, the market always discounts the future, right? So from the market perspective, the market has already discounted it, the increase in the interest rate, which is here. Right? So this is what we discussed. So the key point there is, so in terms of the bond yields, they're already reflecting the increase in the interest rate. When the actual interest rate happens, there could be a minor but potential rally. Okay, let's do the maths. So we're talking about 13 rate hikes of 25 bips each, which mathematically becomes what? 3.25, correct? And what is the market implied rate? 3.35. Why the difference? Difference is because while the market expects to be 3.35, the market also knows it may be marginally wrong. It will be less, slightly more than that. Right? Once you come to that point, then this uncertainty becomes zero. Therefore, you would have noticed that at the time of each of the previous 3 rate hikes which you saw, the market rallied on the day of interest rate hike. Right? So the takeaway to big picture takeaway to you is that the bond price have already come down to reflect the increased interest rate of yields. So you are earning the higher yields. While my cost of borrowing, as I mentioned to you earlier, is linked to the actual increase in the interest rate. So right now, my spreads have become much higher. So the thing will say, the bond price comes down, the yield go up. While in terms of the cost of borrowing is down, so it will catch up across out there and become normal profit for us. Right? Therefore, when you see the elevated yield of 15-16%, that 15-16% sort of leverage by item you see is primarily because the cost of borrowing is low. When it reaches back again, then remember the good old times when the leverage return used to be around 8-9%. That is the right level to look across. So takeaway to you is that in terms of the interest rate hike, the impact of bond has happened. The impact on the cost of borrowing has not yet happened, and when it happens, it gets squeezed. But for you, the good news is that you get an uptick, which is what you're looking at. Okay, and there's one more question. Let me read out the questions to you. I'm reading along with you. So let's see it. The question is that now is a time when most fund managers are recommending switch to shorter duration in order to reduce volatility. Why a Silverdale fund with average duration of less than 2 years and high quality dipped so much in M2M? How much time do you think it will take for the bond prices to go up? The drop in prices was fast. So what is your expectation about the rise? Okay, so a lot of questions. Let's try to understand these questions and try to see. First and foremost, again to take back across there. So this is what spooked the market, as I mentioned earlier. So market was expecting the terminal rate to be around 3%. This is where we are looking at across out there. Then this extraordinary spike we saw in inflation, and market thought that the Fed will now start increasing interest rate much higher. Important note, market has a tendency to extrapolate the present to infinity. If the pandemic is there, it will seem as if the world is going to collapse tomorrow morning. When the technology boom is there, it seems as if the technology will take over the entire world. Natural thing to happen. So for a brief period of time, the market would give you a spike. Right? So first answer to the question is that because the market is expecting a higher interest rate than it was before this spike, so we saw a sharp drop fall in the rates, and that's what led to the across the board sell-off. Right? So give numbers to you. So we are talking about 10-year moving to almost 3.47, and it dropped down to about 3.13 by the end of June. Why did it spike? Because of the hike in the interest rate expectation. Why did it drop? Because of the increase in the probability of recession. And as I'm talking to you, is even sub 3%. Right? So takeaway number one. So when you see the spike in the rate hike, the thing that is time when the IG stroke government good quality bonds will suffer. Then as we saw some pullback happen, so the IG which lost the M2M, part of it recovered back. Remember, it moved from 3.1% 0.1 rate hike to 4.1 rate hike, came down to 3.6 rate hike, still almost one rate hike higher. Right? Same thing here. So from 3 to become 3.35, about one rate hike higher. So the M2M on IG was there. Part of the IG M2M was recovered, and that's very important because this is more important than what I have spoken in terms of rate hike, because rate hike in big picture term is more or less done. This is what you need to be more careful. What happened was, because of preponing of the recession, the high yield fell very, very sharply. To give a color to you, in the month of June, we saw the high yield index falling by about 7.02%. And to give you the one of the highest, the high flying fund, with due regards, of course, Fidelity Asia High Yield Fund was down by 9.6% for the June quarter. Right? This is what you need to be careful about. So if you look in terms of the spread increasing, the spread has increased pretty sharply across this period out there, and that is what actually had to lead to mark-to-market loss. I agree that we have only 23% to high yield, so our impact is not as much. Therefore, what you saw that we didn't follow 10% because of that, because of we are primarily into IG space. That takes to the two other questions, which is that how long the bond price will take to go up. Well, the beauty of being in fixed income is that on maturity, we still get a par value back. As I always say to people, look, you can beat me down, but you can't deny me at the par value on maturity. Now, it's very funny. I'll give an example to you, and it's only for illustration purpose, know the reason. Country Garden, China property, absolutely people are scared about it because of multiple reasons. The company is buying back the bond. We tender the bond, we get $100 back, and funnily, the bond is still quoting at 99.5, 99. So why would it quote? You give it to the company, you get 100, and still quotes at 99. That's the nature of the beast. Right? Same thing with Vedanta. So what is happening in the market is extremely bearish. So even where we have almost 100% certainty of getting the money back because you tender and get the money back, yet we are getting 1.5 points back. lower, which basically means that what you're seeing is only M2M, and therefore, as the bonds are tendered to mature, you would see the uptick happening. Yes, caveat, other bonds are still lying a bit low, so it would take a bit of time. But yes, if history is any guide, we have seen when the rate hike cycle comes to almost end, there is a peak period when you see the maximum spurt happening in terms of the portfolio. So you would see the spurt happening in terms of NAV very, very soon. There is a question on an individual client. As I mentioned, I would refrain from talking about one particular client, but let me give you the picture across of there. So whenever somebody talks about a percentage drop in the NAV, I strongly recommend to you, first and foremost, look in terms of the dividend paid also. So we are on the highest dividend paying fund in the spectrum we are into. We pay $8.40. I do not know any other fund in the field which pays such a high dividend. Right? So if you ignore the dividend, of course, you will see a much distorted picture. So strongly recommend that please look into dividend. Caveat, very important point to note again. See, people try to compare Silverdale bond fund with equities for whatever right or wrong reasons. Keep in mind that in case of every single bond fund in the world, when the bond fund pays dividend, the NAV will fall with the exact amount of the dividend. There's no other legal way to do it. Right? And this is very important because remember, when people invest to fixed income, they're investing into fixed income, right? They require a cash flow they're investing to. When people invest into equities, they don't principally, the broader class, as a class, invest for dividend. So in case of dividend, the share price may not react as much. There are exceptions, of course, but that's the big picture point of view. So to take away, number one, please do not ignore the dividend, which is $8.40. Good for you because fixed so easy for you to compute. And number two, remember, in case of fixed income space, the dividend outflow or cash inflow is one of the most important things which investors look at, because most mature investors know the M2M losses is only a passe, and there's no point in getting disturbed by M2M losses. Mathematically speaking, M2M loss results in higher income. I repeat again, mathematically speaking, M2M loss results in higher total income for the investor. I'm sure you know we've shared this in graphics many times. So just to again remind you, totality period point of view, we are among the top performing funds in the world, and we continue to be there. And you will see more fun as the market stabilizes. Next question is that with the maturity less than 2 years and no credit loss, how do you explain negative NAV in the past few years? Answer. So if I'm paying you $8.40 as a dividend per annum to you, then pure from maths point of view, over last 4 years, you would have earned $34 odd there, right? $34 is a decent income to have by any standards. So the way to look across is that when you look at any fund in the world, the best way to look across is the total returns when it comes into fixed income space. As I mentioned to you again, in terms of equities, the different parameters, and that today is not the forum to talk about those. But in terms of fixed income, you should always look into the return point of view. If you look in terms of what's happening last 4 years, I think this requires a big, deeper discussion. Just to summarize in 3 points. Number one is that because of COVID, we saw a huge sharp fall, and of course, we recovered entirely across of there. And thereafter, the market got spooked because of the rate hike expectations and inflation coming across out there. And then the last point was in terms of recession. And in this three pieces, two things also happened. Earlier it was China, now it's Russia. But in the big picture point of view, remember today your carry is multiple times of what it was 3-4 years ago. And in long term, the only way to generate long-term wealth is to have a higher carry. Right? And as always share with people, no amount of income can make you wealthy, because expenditure raises to the level of income you have. It's only a good investment and technically a good carry which assures you a long-term good wealth creation. I hope I've been able to address the question, but happy to have any subsequent questions people may have.
Yeah, if anyone have any other questions, please feel free to raise them. Sanjay, I think we just missed one part of a question. So Brand was asking, what is the cost of funding for you at the moment?
Cost of funding, okay. Interesting question. Okay, the interesting question is because of the fact that, see, from the cost of funding point of view, I would be slightly careful in telling you numbers because it could be misleading. And the reason why it's misleading is because when you talk about the borrowing, we also take into consideration certain amount of IRS out there. So the mere fact that my today cost of borrowing is low does not mean that you can extrapolate it to the medium term. So that's the reason why I've been very careful in terms of the numbers because of that. If I put a rule of thumb across out there, we'll talk about 22%. But as I mentioned, I'm very uncomfortable with the number because I know it will not remain that percentage in the coming months, and also know certain amount of IRSs could even destroy it because of that. So the question in terms of any views on China bond market as a whole and property market in specific, are we seeing start of restructuring? As you know, China is one of the sparkling star in the world today in terms of the stock markets or what else may be. So China market, as you know, is one of the best performing market in the world, primarily because of the markets have been nurtured. And also more importantly, because of the fact that unlike the rest of the world, majority of the world, and when I think majority, I mean the fixed income stroke world point of view, the world is going to quantitative tightening, and China is going through a marginal amount of quantity easing. So from that point of view, they're giving more stimuli to the economy in terms of its growth. Importantly, the inflation in China is very much under control, so they can afford to actually, to some extent, pump prime the GDP. So from that big picture point of view, we always seen very strong signals from China in terms of the economy stabilizing and upticks sector out there. Yes, there is a lot of hype in the Western press in terms of the zero COVID and stuff like that, which to some extent is true, but not entirely true, because while they do have zero COVID, the way their interpretation and the way they implement is much different from what we see in the Western world. For example, they have the closed loops. Closed loop basically means that the many factories where the employees will live in the premise and therefore they can actually work and stay there, and there's no problem in the production and stuff like that. In places like Shanghai, etc., we are seeing significant relaxation, including entertainment places being open, sector out there. A lot of good things happening. So with that backdrop, coming to your two questions. Number one, market as a whole looks very nice to us. The totality point of view, the property sector in particular, we believe the bottom is almost being achieved with two very important caveats. Number one, the pain is not over. We will see a large number of bankruptcies in the property market, but as a percentage will not be much. As my friend was mentioning to me yesterday, In India, they're looking about 70,000 bankruptcies in the NBFC space, but I don't know how many people in India even bother to know about it. So from that big picture point of view, we would see large bankruptcies, but from pain point of view, from big picture, from big boys point of view, we don't see much downside from here. That takes me to the last piece of the question. Are we start seeing researching? The answer is yes, but it's too early days. And that's one of the most important reasons why we are not aggressively going into China. We are keeping very close watch on it. Yes, we are buying in certain other funds which we manage, but Silverdale Bond Fund being conservative fund, we would be more cautious to more conservative there. So yes, the answer is yes, we are watchful. There are a lot of opportunities, but we have to be also be having ears to the ground. And for people those with a lower risk appetite, I would recommend them to still wait. You may lose some of the upside, but still a lot of upside there, and it will be perfectly fine to do it. So the question is that if we see one more rate hike by the year end, what level are we expecting for Silverdale Bond Fund? Is there a firm possibility of another rate hike this year? Let me see if I understood correctly. So the question is that would we see the rate hike? The answer is absolutely yes. We would see a rate hike happening this year for certainty. And this is what I was telling earlier. The market is already priced in the rate hike. So would rate hike happen? The answer is yes. Would it spook the market? The answer is extremely unlikely. And as I mentioned to you, you would see a bit of a very tiny rally when the rate hike actually happens. So in terms of the numbers, just to give numbers to you, so we are at 1.50. We are expecting the year end to be about 3.25. So yes, we are expecting another about 1.75% increase in the rate hike. And as I put in the chart out there, there's another 75 bips, another 50 bips, and 50 bips, it's like 10, 25 bips out there. So we are expecting a rate hike happens, but no, we are not worried about it because of that. There will be marginal rally, and of course, if we have directed become clear, we would increase the duration of the fund to benefit from it, but there's still time to go. Question is that if possible, could you please share details on the portfolio shifts that you have taken, mainly after the China real estate crackdown and underperformance? I think it's a very old point because since the Q1 2021, which is about 1.5 years ago, we take a conscious decision not to replace Chinese bonds with Chinese bonds. And therefore, we saw the Chinese bond exposure as a fund reducing from close to 30% to close to 15% now. So that is what we have been very transparent and open about right from the beginning. So that is what we have seen across out there. As I mentioned to you, the current quarter, the key holding which you are aware of, like the country Ghana sector, we have seen buyback sector happening. So bonds got bought back, we got par value. The bonds which are still not bought, they are still quoting at 10-20% below the par value. In terms of strategy, there's no change in strategy. We do not intend to significantly increase China at this juncture of time. We see huge value in China, but as I mentioned in my previous answer, and there's still time to go. There's no need for us to rush into it. Depending on each portfolio's risk reward ratio which you're looking at it, we would add to it when we see it opportune. So no, we are not expecting any shift in our China policy. We are seeing value, and we will be watchful on it. In terms of shift in the portfolio, no, we have not done any. There's no strategy shift whatsoever. That we are not taking any dramatic shift action anywhere across. We don't need to do it. Everything is under control. Our exposure to Chinese property continues to be very low. It was 3%, 2.5%, something like that. See, from the economic point of view, China is something one should watch out. And specifically now that the China is opening up, the demand from China should increase. The GDP should improve on it. So that's what I will keep a watch on it. So as I mentioned to you, in terms of the US, I'm looking into three key things. The New York Fed, 10-year minus 3 months, the US unemployment rate, and number three is in commodities. In terms of China, we're watching in terms of how the GDP grows, the sector there, and what are the actual restructuring will take place in terms of the scale. But on the big picture point of view, China is definitely something one should keep a very, very close eye on.
Do we have any more questions from anyone? Okay, maybe one final question, which is an extension to the one more rate hike by the end of the year end question. So, Sanjay, I think you mentioned that we are seeing market pricing in a Fed rate of 3.25% at the end of the year, which is significantly higher than the 2.5% long-term rate. So, is there any possibility of further surprises where market might pricing even more rate hikes by the end of the year? What's your view on that?
Okay, so the answer is already there in the month of June. So in the month of June, as you saw, the market did increase the rate hike much significantly. And within less than 2 weeks, it realized that if that happens, we will have a much earlier onset of recession. So mathematically speaking, while we can never rule out it, from practical point of view, it looks very difficult because we are already in the month of July, and where we stand today, we're talking about recession coming in early 2023. So we have a runway of less than 6 months. Now, if you want to even shorten the runway, it's something I'm not sure people like to do, because if you still shorten it and you do a rate hike, and after 3 months you have a recession, it would not look the best in the track record of any central bank in the world. So my takeaway is this way: look, when the rate hike happens, what are you going to do? You're going to do short term. So rather than being too obsessive about the rate hikes and the recession, the way you could have said that, look, if rate hike happens, fine, we take short duration. Recession happens, fine, we move to high quality. So as long as you are into short duration, high quality, you will reasonably well. So while there is never end to greed, there is the end to what return you should be getting because of that. But from big picture point of view, we are very close to the bottom in terms of where it could be in terms of rate position because of that. Yes, I have a caveat in terms of the bond spreads, and therefore I'm recommending to be in the higher quality, because if the Fed doesn't take corrective actions and the recession becomes slightly longer, then of course the spreads could become bad on the totality portion of it. So my similar message to the audience would be that as long as you appreciate the big picture and you're almost there, this is the time when you can actually make above average returns from July till September. This is the 90 days period zone you have, because come September, we will have the data points which will feed into the econometric model. We have an input on 16th of March 2022 in terms of first rate hike. We are 6 months thereafter in September, when we have the output, we know the exact impact of the rate hike on the economy in terms of multiplier impact, and therefore things will be much more clearer. The moment things become clearer, the volatility will come down, and therefore the extra juice you're getting across of there will start coming down. So that's a big picture point of view. And again, with two small caveats: if you don't believe it, stay put. If you believe it and you find it difficult still, then we can fix, of course, to the fixed maturity funds to lock in your returns.
Okay, thank you, Sanjay. I think we've also just about reached the end of the session, especially the timing wise. Okay, so thank you once again, Sanjay, for the insightful presentation. We hope that we've been able to address all of your queries. And if you have any more queries, do feel free to leave them or drop an email to ir@silverdalegroup.com. Once again, I think given the current elevated use, it seems like one of the best time to achieve above average return to enhance your long-term returns and getting into today. So thank you, Sanjay. And thank you everyone for joining us. We'll see you.
Thank you very much. Much appreciate your support and look forward to seeing you soon in the next Q3. Thank you.